Good morning, good afternoon. Thanks everyone for joining. My name is Kevin McPartland. I'm the head of market structure and technology research here at Coalition Greenwich. I'm really excited about the conversation we're going to have today. We're going to do a deep dive into portfolio trading in corporate bonds. It's come a long way in the last 4 or 5 years. Something that started off as sort of a spreadsheet workflow for very specific use cases has become a common tool for most in the institutional corporate bond market today. We have a great panel. We have a lot to talk about. We have William Wolcott from Goldman Sachs, Ed from State Street Global Advisors, and Paris Pender from Trumid. Thanks all for joining. We'll jump right in the interest of time. I do have a lot of questions for you all today. So Paris, we'll start with you. Hoping you can set the scene, maybe talk a little bit about sort of how big was portfolio trading coming into the end of 23, sort of maybe some of the history for anybody that's not aware, and then talk about how 2024 has started.
Sure, and thanks very much, Kevin. So 2023 represented a significant milestone in the protocol, and really yet another sign of its growth trajectory in general. We saw a record market share for the protocol in December. PT was around 9% of trace volumes overall that month, according to Trumid analysis, and about 8% for all of Q4. From the way that 2024 is starting, we'd expect for the general growth pattern to continue. As you mentioned, it's probably a good idea to take a step back and look at PT in the broader, historical context as well. The protocol really began properly, call it around 7 years ago, maybe 2016 or 2017. And it's notched steady gains in market share since then. The protocol, really got a boost through the pandemic in 2020, when clients needed, efficiency, certainty of execution, and to really be able to, accomplish their agenda without slippage and move on to the next thing. What we saw from there was kind of interesting. In 2021, you saw, some, incremental dealers trying to get into the space. I wouldn't call it a rush exactly, but there was certainly, some folks kind of piling in, and, maybe paying for market share to some extent, to play a role there. And clients obviously loved that, but it wasn't that sustainable. And so in 2022, you saw a little bit more of a retrenchment, where the space continued to grow, but pricing perhaps stepped back a little bit. And we saw, some clients kind of, grumbling about whether RFQ could be cheaper on this trade or that, and so forth. The protocol continued to grow, however, and all of that settled out, which led to a really solid and kind of normal feeling 2023. We observed on platform that dealers were very efficient in terms of providing quotes and standing up and providing liquidity. Pricing was reliable and expected, and the protocol really notched quarter after quarter of gains, ending with that record in December at that 9% market share. We see great things to come from here. At Trumid, we're preparing for more growth, right? And so we're investing, in the speed, scale, reliability, et cetera, of our business, and in supporting clients to make decisions more quickly and easily.
Yeah, 9% of the total market is impressive in really what's only been 5 or 6 years. Ed, I'll bring it over to you from the buy side perspective. Maybe if you could first give everybody some insight into sort of what you're focused on specifically day to day, and then talk about how portfolio trading sort of gets used on your desk, and again, like how that's grown over the last couple of years.
Yeah, sure. Thanks, Kevin. So I trade high yield credit here at State Street Global Advisors. Why would you use portfolio trading? There's a couple of different reasons and a few factors that we weigh. One is the size of the flow, both the notional and the ticket count, and then also weighing and understanding, which I think is important, the difference between the algo and the portfolio trading market and the institutional market. They're two different, and there are times when we'll have a flow, and pivoting to bigger sizing and trading that in the institutional market is a better outcome for our clients, and there's better execution there. And there's also a time where these algo and portfolio trading desks are very aggressive, and trading it in a more diversified, larger basket of bonds is a better outcome. One other thing I wanted to highlight is the recent change that we've seen on our side is the client behavior. So clients asking us, how long will it take to invest 250, 500, up to $1 billion in high yield, for example, and I'll maybe let William touch on the investment grade side. But that answer a few years ago, 3 to 5 years ago, was a week, maybe 2 weeks. I'm pretty confident 250 to 500 we could do in a day, depending on the day and the market backdrop, up to it really depends, but probably up to $1 billion we could do in a day, depending on the price. Now there's going to be a menu for that, I'm sure, but I think that's changing the asset allocation strategies with our clients.
And so William, if we could bring it to you. So Goldman, pretty well known as one of the leaders in PT over the last couple of years. So how has that business evolved? One of the other questions we get a lot, and we already got from the audience, is if you could help us understand, like today, and I know it's hard to average, there's so many ifs, ands, or buts, but the size of portfolio trades, like how individual line items and then the trades as a whole, sort of how that size dynamic has changed over the last few years as well.
Sure, Kevin, and happy to elaborate. Also, just want to say, thank you for having me today. Great to be a part of this panel and spending the time with the clients on the Zoom. Portfolio trading, I think, as Paris alluded to, it got started around 2017. It's a place that we've invested and really leaned in at Goldman. It represents about 20% of our volume, so we're a little bit outsized relative to the market in terms of the focus here. But it's been a place where we've tried to invest and differentiate ourselves. I think what we've seen opportunity is across the whole stack of products within credit. So that's corporate bonds, CDS, CDX, ETFs. Portfolio trades are a way to interact with those, custom baskets. You have futures on a lot of the credit products, but there's like a growing toolkit, for clients to use and access. Ed alluded to this in terms of being able to put risk to work quickly, efficiently, and I think portfolio trading and some of these other macro products have stepped in and created, a growing opportunity set for clients, to deploy capital and to be tactical, within the corporate bond market. I'll answer your question around just in terms of, sizing. So I think last year we priced 8,000 portfolio trades at GS. That on a busy day can approach 100. So that's one every 3 to 4 minutes, something like that. We see a lot of activity, especially around month end. But it's become part of the day-to-day process, for us, and that's over 300 different clients transacting. I would note that the average size of those trades has come down over time. So I think the average trade size last year was around 60 million in market value and around 100 QSIPs. And there's a pretty large tail on either side, I would say. We've seen very large trades in the billions go through, large liabilities that are being matched, or large fund flows. We've had some large fund flows go through the investment grade market. Those have been multi-billion-dollar trades, here in the last couple months. And I'm happy to talk more about that. And then we're seeing people use it every day for fund flow management, and where, like in the past, a $50 million inflow or outflow may have been managed through the primary new issue market or through trading a few blocks within portfolios. We've seen clients also leverage portfolio trades as a way to manage those fund flows across more of like a pro rata slice of their portfolio or their underweights and overweights.
Is there a dramatic difference between IG, high yield, and then even emerging markets, if we've gotten there yet? And William, Ed, whoever wants to jump in first.
Yeah, I can provide a little perspective from my seat and from Goldman, and then I would love to hear from the others. It's around 80% of our volumes at GS are investment grade and 20% are high yield. I think you have in the investment grade market, you probably have some larger liability focused investors, and this product had also been used as, I would say, like a block tool to match assets and liabilities, so sourcing block risk on sort of the asset side of the equation. High yield is probably more historically total return focused, and then you've got more idio risk, within high yield that makes it a little challenging, but about 80-20. And then we have seen growth in our emerging markets PT effort, I would say, over the last couple of years. Matt Hargraves runs point on it here for us at GS, and I think he and that team are outstanding. And anywhere we're seeing growth in the ETF market, I think that's where we're also seeing adoption here, where clients are looking for beta scale, different tools to manage, their fund flows and their investing needs, and they're finding portfolio trading as a use case there. And there's been growth in those EM ETFs as well.
Well, growth in the ETF market, Ed, that goes straight to you, J and K. Great example, right? So, obviously you're looking mostly at high yield, but love your thoughts.
Yeah, I am. So just on the percentage basis, we've been about 20 to 25% over the last 3 years in portfolio trading. And, with the creation redemption expertise that we have, it's more of an offshoot of that. And that's how we developed, I think we did our first portfolio trade in 2017. So we've been pretty active in the space over the past few years. And, valuing a basket of bonds is an offshoot of, taking in the creation baskets and the redeem baskets, but it has changed, and the market has been more mature both on the ETF side and the PT side. It's enabled us to essentially have baskets of bonds trading in our non-ETFs as well. But the days of we've seen them in the create baskets as well, but PT baskets, and maybe William can comment after, but people using portfolio trades to try to dump in a bunch of bonds that are for sale or they're not valued in the market at the right price is changing, and it's gotten better. And again, we've seen that on the create side as well. It's not happening as much, but it does happen. And it's kind of it's a different way of pricing it as well. So what we've seen is live pricing versus future strike pricing has eliminated a little bit of that. Now, what I mean by that is pricing a spread to BVAL, for example, or FVMP. Trying to eliminate some bonds after the fact is harder than when you can do live strike pricing, and I've seen it actually be sharper as well. You also take out market moves, so if there's news out in the market in the sector or in the specific bond, trying to eliminate that 4 or 5 hours later when you're trying to price it to a 4 p.m. strike has been challenging. But yeah, to your earlier point, we do have the expertise in house of valuing bonds and within the ETF structure that we have. But I don't know, maybe William, you can touch on how you hedge the risk using those ETFs.
Yeah, no, I'm happy to. I think ETFs are core to what we're doing here at GS, and a big part of our portfolio trading business. I think there's a bit of a misconception that a lot of these portfolio trades exit through ETF create redeem. I'd say that's not the case. Maybe 3 to 5% of our volumes are exited through create redeem. The reality is the portfolios that our clients are asking us to provide liquidity on aren't that fungible with the ETFs. But what I will say is the ETFs are involved in the pricing and the sort of risk management on probably 100% of the trades that we're doing. So ETFs, from a hedging and from a reference pricing standpoint, are a big part of what we're doing. And I think when I think about portfolio trading, what's the value proposition for clients? I think it's a couple things, but number one is liquidity aggregation. So you're engaging a dealer. At Goldman, what we're trying to provide is aggregated liquidity across our voice, electronic, and ETF platform, sort of in a single touch and access point. So aggregating that liquidity together, and then allowing that liquidity aggregation to hopefully lead to better pricing at a portfolio level. I would say the ETFs, from a percentage of market value traded every day, that's been growing year on year, in IG especially, and also in high yield. There's days where the high yield ETFs trade more than the underlying bond market. And so I just think these are an essential part of the toolkit. I know this is a PT webinar, but we think about the things very similarly. Pricing a create redeem basket, pricing an ETF block trade, pricing a portfolio trade. And I think that's something our clients are also doing, and especially finding a value in around larger fund flows or situations. Does it make sense to buy ETF here? Make sense to do a PT? Okay, which bonds do I put in the PT? If you get back to that liquidity aggregation point, bonds that are in the ETFs are held and traded by the ETFs. You would probably expect to trade, better in a portfolio trade, all things being equal. And I think Trumid has done some work there around, maybe Paris can speak to this, around helping clients with analytics around liquidity, diversification, overlap with ETFs, and other things. And I think that is leading to what I would call a more successful outcome, and something I track very closely is, repeat business. Are our clients having a good experience when they come in to trade with us? Are they coming back? And what can we do to continue to deliver on that? But yeah, Paris, maybe you can, provide some insights there.
Sure. So, yeah, completely agree. PT is interesting because it's really the first step in the conversion from macro to micro. You really start with the end investor who decides to invest in some fund. And then you end up with a trade, and potentially a PT trade, which is going to convert that investment thesis into bonds. So PT is really kind of the first step there, and the great value that dealers bring to the process is in doing that conversion then into micro, into the individual bonds, and kind of fanning out that risk. It's kind of interesting because after that, one of the issues that crops up is that then dealer balance sheet will grow from there. That can be grow both in terms of gross notional, and also importantly in terms of gross line items. That can be potentially a problem because what's the expression, that dealers are in the moving business, not the storage business. So that risk ultimately needs to find a home. Now in the blocks business, in block trading, that's sort of a solved problem, right? Because dealers and clients both are set up to buy and sell blocks. And so if a dealer buys a block from one client, they can sell it to another, they can go out and market it, they can potentially capture bid offer on both legs. And so there's kind of a good circle there. But in the PT business, clients initiate PTs, but dealers can't really send them back in the other direction. So instead, there's a sort of combination of algos, single name trading, ETFs, and so forth, that manage this transformation to from macro to micro. And as William was mentioning, each one of those outlets is not perfect, and there's no one which is going to kind of completely take all of the risk from a portfolio trade, into some other form. The ETF being a good example, that 3 to 5% number, kind of jives with what I know, so it represents, kind of interesting problem. So we've made some direct stabs, at this at Trumid in the form of recycling the risk from dealers to client. And while kind of technologically it all works, there probably needs to be a bit more of a sort of PT mindset or PT counterpart on the buy side, or some framework that makes all of that work. Maybe William, you can probably speak more to that kind of conceptually. But it's an imperfectly solved problem right now. Kind of coincidentally, we see dealer balance sheet growing in recent weeks and months. And while that may or may not be related to all of this, I expect that this will become a focus. I mean, I'm sure it already is a focus, and I don't want to predict whether it'll go up or down, but you can't grow balance sheet without being able to shrink it too. So I expect for there to be a lot more on all of this.
And I can guess the answer, given this is a panel about portfolio trading, but what does portfolio trading do, or might it do, to liquidity overall in the U.S. corporate bond market, right? On one hand, it's improving liquidity, it seems, and execution quality, especially in these index names that are tied to ETFs. But some people feel like there's a risk to the rest of the market. It's the single line items, bonds that are out of the indexes, where they're going to lose a lot of the focus. In some ways, we've seen similar concerns as the equity market has sort of gone more to passive investing. So, but yeah, what do you think about its impact on liquidity, both the good and the bad? Whoever wants to jump in first.
I can jump in there. So we definitely see this trend, and I think it's been alluded to, before, of more PTs for smaller notional. kind of more diversified, lower transaction costs, and so forth. We've certainly seen this over the past couple of years. I'd say in the numbers, it's something like, average trade size has gone down by 15 to 20%, while volumes have gone up. Some of this does seem to be a conversion from the block business. As William was mentioning, if you get a small inflow in a fund, historically, clients would put that to work in a core holding, traded as a block. And that's how they would, kind of manage that business. Now you can, basically take a, pro rata slice of your portfolio, put it out as a PT, and then, get the flow done that way. And that can be very attractive from a tracking perspective and so forth. We see this, creeping into, kind of all parts of portfolio trading. So it's a good evolution in the market. And I think part of the reason for the growth in PT.
I would just add a couple, points of perspective. I think, a lot of that was well said from Paris. There is also like a bundling, I would say, aspect to this from a value proposition of being willing to take the good with the bad. And that's a question, I get asked a lot, is like when to do an OWIC or BWIC versus when to do a portfolio trade. In a lot of ways, I think the execution can come out in a similar place. But one place we have seen is, there will be a willingness on our part and others to take on challenging bonds, take on less liquid bonds, take on that tail, if you will, in exchange for, maybe doing other things that can be, more easily monetized or replicated. So there's like a portfolio effect. I've spent a lot of time with our team internally, thinking about things in portfolio form. And I think that's something too clients are coming around to, of, thinking about the execution in aggregate versus at an individual line item level, and, how to weigh those pluses and minuses. In terms of like overall liquidity, I think like that was a concern when I was our ETF market maker at one point, and there was, a narrative around, credit ETFs were going to blow up the bond market and we're going to be, a big source of problems. I think we've seen, the opposite around periods of volatility, that, ETFs are, a place of, where there's increased risk transfer, volumes tend to go up. They're a clearing level, and PT and other protocols that have stepped in, have also electronic trading. I think around those periods of heightened volatility, you'll tend to see those volumes go up. And that's also a place where I think we've seen opportunity and alpha, for our clients and for ourselves, where a lot of these bigger dislocations that have happened, that have been localized around, different, events, can be macro risk on or risk off moves. And I think having the ability to respond to those in list form or macro form is just an important thing. And I know Paris, alluded to this a little bit, and this is something we've worked with Ed and his team on, is just how to translate those flows to our clients in their investment process. So when we see that ETF block seller, you may not be set up to buy that particular ETF, but are you set up to buy a basket of bonds that overlap or somewhat look like that ETF, that are aligned with your investment process? And that's a place this year that I think we're going to see a lot of innovation and a lot of change, in a place that, we're investing, along with others to help increase that risk transfer and the velocity around these bigger flows, which I think will ultimately be additive to, liquidity in the marketplace.
Yeah. Portfolio trades are fueling ETFs, but then ETFs are also fueling portfolio trades. So very sort of positive relationship between the two. Ed, I want to bring this over to you. Obviously, we're talking about how much it's grown and how important it's become to the marketplace. So I'd love to understand your workflow, how much you're doing electronically. Are there still spreadsheets around? And then the follow-on question is, like, are there still tech hurdles? Obviously, State Street, big organization, you have the resources, but are there tech hurdles for others on the buy side? And then, would love to sort of talk to Paris and William about your clients and sort of any hurdles they may have seen.
Yeah, sure. So we were using spreadsheets not too long ago, probably 2 to 3 years ago. Recently adapted these electronic platforms, which have been nice. One thing before I get into that, I just wanted to touch on what Paris and William were saying earlier about kind of the illiquid bond portion of the market. I think that is also on the buy side to figure out what bonds are appropriate in a portfolio trade. Not all are. And I think there's sometimes, I mean, maybe this goes back to the live pricing point earlier. If you do live pricing versus forward strike pricing, it enables you to remove some of those bonds. So if I'm getting a list back and there's one bond that's 5 points off where I think the mark is, it's easier to remove that bond, which should not have been initially put on that portfolio trade, versus, you know, keeping a list that is, you know, more liquid. And to William's point earlier, there are some of those tails that are going to be in there, but there's not going to be the tougher bond to trade. So that said, we do use I'd say all platforms. We've kind of settled into a few. I'd say, you know, if you're trying this out for the first time, try all the platforms, see what you like. But yeah, one of the tech hurdles is the recycling of risk. So if William and his team or another dealer gets hit on a portfolio trade, how can I see that list and what's appropriate for me to see and how fast can I see it? Currently, we're having salespeople call us, and if the list is 60, 70 items long, it's the first person to get to that bond wins. So it's still archaic in that front, and you know how that can be improved. And I don't know if that's a direct stream to myself or to a certain group of clients or how that works, but that's still another tech hurdle to come probably pretty soon.
Yeah, I can comment a bit on just kind of the overall, you know, market and you know, kind of what portion we think is electronic and so forth. It's hard to come to an exact number there, but just, you know, kind of connecting a few dots, we'd estimate that around, you know, 80% of the volume is now on platform. You know, there's still a lot of, you know, bespoke or bilateral trading, which isn't really well suited for a vanilla protocol, you know, something which requires a lot of back and forth between client and dealer. And there's also, you know, a lot of collapse activity out there, which isn't, you know, really electronic. There's also, you know, should throw in their cross asset activity as well, which sort of fits more into the bilateral bucket. You know, that said, we've seen this stat go up from, you know, 7 years ago or 5 years ago, call it, you know, to 80% now, which is an amazing rise. You know, if you compare it to RFQ or other protocols, you know, where are they for their addressable market? It's, you know, significantly smaller. So, you know, platforms are just the natural place to do this type of trading, you know, and we aim to, you know, offer all of the things that clients need to get their trades done. You know, the reality is that platforms add a ton of value in the space. The aggregation of responses, you know, normalizing them, dissecting them, adding comparables. If every client out there had to build all of that by themselves, it would be a nightmare, and it would be inefficient. You know, it might as well be outsourced, you know, to a third party, you know, to build. So, you know, from that perspective, it all makes a lot of sense. And, you know, we just see the electronification process, you know, continuing from here.
Yeah, if I can jump in real quick, what I was going to say is that 2 to 3 years ago, with spreadsheets, you maybe went to 1 or 2 dealers. I think most guys are going up to 6, 7, 8 dealers now, and I think we got pushback initially of the amount of dealers you showed. Now I think it's, you know, pretty market standard to show you know, a vast majority of dealers the portfolio trading comp.
Is that your experience as well, Ian?
I think the experience, you know, around a couple things, you know, the platforms, you know, adding scale and velocity to this. I think that's absolutely true. You know, that's happened, especially like solving for, you know, workflow and straight through processing. So I think clients are finding ways to use PT from an efficiency standpoint to manage a portion of what they're doing. Two-sided rebalance trades is another place that we've seen, you know, a lot of growth in this protocol. You know, having sort of that instantaneous liquidity. But I think anything that can solve for, you know, efficient pricing, processing, the ability to put, you know, a number of different counterparties in comp. Ed alluded to this. You know, the number of dealers that are involved in that wheel is continuing to grow. You know, I think depending on the market, there's 3 to 5 that, you know, have kind of been there consistently and showed up over time. But, you know, I expect that to continue to grow and evolve. You know, I think all-to-all portfolio trading is something that will come eventually. And so, you know, as I've been out having some client conversations recently, and we've been talking about this problem of like, how do you translate these portfolio list back to a client in their bottoms up investment process, such that it's aligned, what they're doing bottoms up, top down. I've been encouraging them to think about like, okay, what would you need to do internally to figure out how to price a portfolio trade if that were available. That's essentially what the ask is here, is like, hey, we just did this trade, it has 60 line items, what percentage do you care on and at what price? Is the problem that's being asked to solve. So I think, and I know there's some work being done. The platforms, and then I would just say, and this is just the reality, is that we're under margin and fee compression across the board, and I think that's going to be also part of this, as we're seeing there will be continued pressure across all aspects of this to become more efficient, maybe for fees to come down around some of these protocols. And that's something that we're very focused on here at GS, is being the lowest cost, most efficient provider, and continue to invest to kind of move the ball forward there.
William, what makes a dealer successful here? Is it about balance sheet management, hedging, pricing? I mean, I'm sure it's all of the above, but like, what do you think are the key elements that really you need to have in place so this can work over the long term?
I think it's a couple things. It's a hard question. It may be different things at different places. I can speak, mostly to what we've experienced here at GS. I think a team-based culture and mindset is essential. This changed, like everyone sort of pricing every bond that came into their book and being sort of the arbiter of that, to now like risk being priced more centrally and decisions being made a little bit more centrally. I'd say we have a hybrid sort of approach at Goldman. We try to, have a what's best for GS overarching, strategy, but then also, realize that we have a lot of humans and a lot of people across the business involved, and they have, a way to express their voice and their agenda when these things come along. There's investment in technology. I don't, I think, Paris was at GS, a number of years ago, and there's been a longstanding investment around technology and being able to increase, the velocity of what we're pricing on a daily basis. You can imagine going from pricing 1 or 2 portfolio trades in a spreadsheet a day to 100 electronically. That takes investment over time. And then, I mentioned this a few times. I don't want to beat a dead horse, but I do think the ETF market and being able to operate effectively from a liquidity providing standpoint, accessing that risk, and then also doing the create redeem and the sort of the muscles that are required there are similar to those in a portfolio trade. So for some of our businesses internally that have been investing in PT, that's often, we're all encourage them to, to start out is investing there. So anyway, that's my perspective. Love to hear from others.
That's great. No, appreciate that. Yeah, Paris, go ahead.
Yeah, I was going to say, I think one of the kind of interesting ways to tie a lot of these themes together is to think about like pricing of PTs versus pricing of RFQs and how all that works, and then how that kind of spreads out kind of across the protocol or the landscape. There's a lot of nuances to PT versus RFQ pricing. Some of them are kind of obvious, and some are not. Some come from really like looking at things from the client perspective, and some come from looking, from the dealer point of view. So for a client, the number one question that you need to ask yourself when you're thinking about setting out a portfolio trade is, do I need all or none execution, or am I okay to leave the tail unfilled? You also want to ask, how immediately do I need to get this trade done? Do I need it all right now? Or can I work it over time in order to potentially get a better result? From the dealer point of view, it's very different to price an all or none basket versus a collection of singles, because when you're pricing singles, you're worried that you're going to get negatively selected. You're effectively going to trade the bonds where you're the most aggressive, and you're going to miss on the bonds where you baked in more margin, or you were, kind of more conservative in general. And so you're effectively, selling a sort of option to a client to trade, only your like worst quotes, right? Worst, being from the dealer perspective. So you have to be, a bit conservative on all of your quotes in order to, account for this. And so that means, as an example, if you were to try to price a portfolio by just assembling that collection of single name quotes, the pricing would look very conservative. And on the other hand, when you price as a portfolio, you can price some of the bonds a little bit too aggressively, potentially by accident, right? Some of the bonds more conservatively, and as long as your net quote is at the right level, then you're happy and you don't need to be extra conservative, across the board. Kind of as William alluded to, this dynamic is probably the most extreme with mixed lists, especially where the two legs net in some way. We see PTs on mixed lists being priced, something like 25 to 30% cheaper than you would expect for the two legs, individually, like two PTs individually. So, to kind of like put all of that together, right? Like, something which is a trade, which is a mixed list, that needs to be done in full right now. That's a PT. On the other hand, a few chunky line items in a single sector that can be worked over time, et cetera, that's an RFQ or a block trade or something similar. In between, it's really shades of gray, and the details matter a lot. I would just highlight that from a general pricing perspective, it's a tough problem. It's tough to have just any random list thrown at you with potentially a collection of difficult bonds, and to be able to kind of come out of all of that unscathed. And so there's a lot of kind of features which I think will need to be incorporated kind of across the landscape for some of these things to be resolved. Thinking about like all-to-all portfolio trading, kind of translating things back to the client process, and so on and so forth. So at Trumid, we help clients with this problem on a daily basis. We can accurately price where PTs will clear and compare them to other forms of execution, and help make that decision. And we'll look to extend those analytics more and more to help kind of evolve the space as we're discussing.
That's great. Thanks, Paris. We don't have too much time left, and we're actually getting a lot of great questions from the audience. So thanks everybody who submit those. Ed, maybe I'll put this one to you. There's a few questions in here about sort of speed of execution for portfolios. And of course, every basket's different. And William already talked a little bit about this, but can you give us some idea? Is this something where you can get, a couple of minutes, seconds, and you're done? I'm sure some take a day, but could you give us some insight there?
Yeah, sure. So depending on the size and the composition of the list, what I've found is if you put it out in comp, and again, it could go to 3 to 5, depending. And William's right on that earlier. Depending on the list, if there's a certain amount of people that are going to price it pretty aggressively, but typically 30 minutes, I can have it back, and you can execute a couple $100 million list in high yield within 30 to 45 minutes timing.
Okay, and sort of, I assume that's down from a day, hours
Easily.
Before, right?
Yeah, and again, if it's to my earlier point where you're really going to try to ramp it up and trade 500 to $1 billion, the timing is probably a little bit longer, but that could be down from a week plus.
Okay.
I would just say like I would add the wire time we've seen as short as 15 or 20 minutes. I don't know if there's much to be gained by that, to be honest with you. I think, maybe 30 minutes is probably the average. Depending on the number of line items, I think our process takes, 2 to 5 minutes, something like that, to kind of, grind through. And that's something that we're continuing to, to try to get down and invest in a world where, maybe there will be hundreds of these trading in a day. But, that's just sort of, where we are right now. And, I think it's a place that, there will be continued investment and advancements as we go along. And, I think that will certainly come down over time. I think, that was certainly my experience as our ETF market maker, that, those wire times, went down, and the platforms frankly accelerated a lot of that happening.
William, I assume at the simplest form, a basket comes in, you have algos that sort of automatically populate prices that you think work for you, and then a trader sort of eyeballs that to make sure everything looks right or looks for exceptions, and then sort of off you go, at least in the common case. Does that sound about right?
Yeah, that sounds about right. And, we've been investing to, connect directly to a number of the platforms, also, some clients directly, but, to be able to upload the portfolio list when it comes in, to be able to price it and then send it back and continue to invest, I would say, in automation. And then, yeah, like I mentioned, we have, a human element as well. And, I think for things that are liquid, smaller size, maybe the human eye is spending less time there. And then the larger, less liquid line items, maybe that's where, people are spending a little bit more time and energy. And, that's where the push and pull comes in. And I mentioned this, earlier is like, what does it take to be successful here is having that ability to, like, kind of see the forest through the trees, think about it holistically, not get too caught up on one line item. And that's certainly on the dealer and the client side. And I spend the vast majority of my time on the 2 or 3% of the trades that are difficult and hard and don't go well. And that goes with the territory. But I think that's something that we're continuing to try to adopt or improve our process around.
Yeah, it's kind of funny.
And then
the main thing. Oh, sorry.
No, please, Paris, go ahead.
Just to chime in, the main thing that we recommend for clients around all of this is just not to throw bonds into lists which are effectively untradeable. If you put a bond into a list where a dealer is going to get stuck with it until maturity, that's going to cause a problem for them. So if they end up trading it, that's going to be an issue, or more likely they're just going to kick it out, and then that can cause kind of problems on both sides. So it's really like that kind of like tail of the bonds, which is like the kind of relevant part that we tend to focus on the most. But otherwise, for the most part, anything goes in these trades, which is really great. And I would just chime in general that we've seen a great evolution in this space, on platforms as well, like great increased comfort in doing large trades on platform, in comp and so forth. We've seen things like nearing $2 billion IG trades put out in comp to a couple of dealers, get priced like significantly smaller trades, and go down smoothly. And kind of I feel like we're circling around a lot of the same themes, but this is obviously great for the end investor to know, yes, I just put my dollars to work in credit. I have a clean and well-defined entry point that didn't straggle across days and weeks. It got done at a discrete point in time. It's great for tracking purposes, for historical analysis, comparison to other investments and so forth. But simultaneously, as we mentioned, we're also seeing this trend of higher volumes overall, but spread out across more trades for smaller notional. So PT is really being kind of pulled up at both ends of the spectrum. And again, it really speaks to the robustness of the market. The market has just been growing, but growing at a kind of mature pace.
Great, thanks. We have so many questions and I'm running out of time. I want to make sure we save time for the what's next question. Where do we go from here? So William, there was 2 or 3 questions put in asking a similar thing about, you mentioned about doing, I think it was 3 to 5% that you can hedge with ETFs. So in short, the question was, well, how do you hedge the rest? So can you talk to that briefly?
Yeah, sorry, and maybe I wasn't clear. 3 to 5% is exited through ETF create redeem. So like we buy a list of bonds, we sell an ETF, and then we create those ETF shares with the bonds that we bought. That's like, something like 3 to 5%. I think that number is always a little smaller than what maybe people would expect. I think close to like 100% of the trades, certainly anything big directionally, are going to be priced off of and hedged where the risk is immunized with an ETF, where we buy, a list of bonds, sell an ETF to kind of hedge ourselves, and then we're going to work out of that over time. I'd say our focus has been on trading with our clients on the back of these portfolio trades, in particular trading with our clients who are doing business with us on the way in, trying to make sure that we create that's like a way we can add value, is liquidity and providing that liquidity, and that's a two-way street. And so that's something that we try to be cognizant of. So generally the focus is on trading with clients on the way out, and then I'd say using the ETF to sort of keep our overall directional risk you know, in a you know, sort of as close to home as possible, if that makes sense.
Yeah, that's great. Thank you for that.
And just, you know,
Okay. Oh,
yeah,
please.
sorry. One thing I would add, and maybe this can be my what's next, is just I think we'll start to see more of these portfolio trades trade with in ETF delta, or like ETF shares accompanying them. So clients using ETFs for cash management, for liquidity management, for tactical trading, and then switching in and out of those ETF shares into the desired bonds, and affecting that as a simultaneous risk transfer. So like you would trade a convertible bond with delta, doing portfolio trades with ETF delta, that maybe was being held as a placeholder, I think is a place that we'll see you know, growth, and we've seen some, you know, some trades go through recently around that theme.
That's fascinating. Ed, what about you? Munis, two-sided portfolios, CLOs, like where else is this going to go?
Yeah, I think the all-to-all market in portfolio trading is going to be the next step. How that the ecosystem works there is still TBD, but we've seen the all-to-all functionality happen in the RFQ market, and it ramped up pretty quickly. So where that goes is going to be the next step. And then we touched on it earlier, but you know, how do we recycle the residuals? I think that's going to, you know, be one of the next steps in the PTs.
Fascinating. And Paris, last but not least, what's next? What's on your product development roadmap there?
I would just say in brief, you know, well, in response to all of these things, or you know, in addition to all of these things, just analytics to make them all digestible to the end client. Because at the end of the day, you know, they're the ones who need to engage all of this and do so, you know, efficiently and so forth. And so analytics will be the thing from a platform perspective to you know, make all of this you know, both possible and efficient.
Yeah, ultimately, this is one big math problem everyone's trying to solve. So that makes sense. Great. This has been amazing. I literally I can't remember the last time I've seen so many questions from the audience. So apologies, there's a lot we didn't get to. We're going to do our best to consolidate them, circulate them with this group. If you guys are willing, we'll send them around and see if we can get back to everybody with some additional information, because these questions are really interesting and I would love to hear the answers to them as well. So thanks to the audience for spending some time with us today. Thanks for all of your questions. Obviously, you've been really paying attention. Ed, William, Paris, great conversation. Appreciate you taking the time. And yeah, hopefully we can have a follow-on you know, a year or so from now and see where we've come. So thanks for being with us.
Thanks, Kevin.
Thank you, Kevin.
Great.
Yeah,
Have a
thanks,
great
Kevin.
day, everyone. Thanks so much.